Okay, you're ready to go.
So thank you. All right, good afternoon, everyone. I'd like to call this meeting of the Annual Funds Committee to order pursuant to City Ordinance 64457. Ms. Ali, can you please take the roll?
Mayor Jones.
Present.
Thank you. Comptroller Green.
Here.
Chairman Lane.
Present. Next order of business is the approval of the September 23, 2022 meeting minutes. I'll entertain a motion.
So moved.
Second.
It's been moved and properly seconded. Ms. Ali, can you take the roll, please?
Mayor Jones.
Aye.
Comptroller Green.
Aye.
Chairman Lane.
Aye. Before we get to the investment update, just want to start with our presentation. Can everyone see my screen?
Yep.
Awesome. So just want to make sure we're going, so everyone knows the general public knows what we're doing here today, as well as our participants. So this is our annual Funds Committee meeting. The purpose of this is just to make sure that we go over our investment update. So we'll hear from our investment managers and we'll learn about the state of our city's finances, our investment portfolio, and our bond portfolio. It's also to go over the Home Mortgage Disclosure Act, so our HMDA report, and see how we're trending compared to our previous years in the city as it relates to different types of loans, so home loans, refinancing, and home improvement loans, and also small business loans. We're also going to be looking at our Banking for Economic Equity scorecard, what that has entailed, the information that we've got from it, and then celebrating the good work of our banks in our city. We'll be approving our city depositories and also our broker dealer list. So that's what we're here to do today. I'm going to stop sharing here and hand it over to our investment managers for their presentation.
Sure. Thank you, Treasurer Lane. Hopefully you can hear me. This is Danny Nelson with PFM Asset Management. Glad to be here today. I'm going to share my screen. Just give me 1 second here. Can everybody see that?
Yes.
Good. Okay, thank you. So unfortunately, my colleague, Leslie Spencer, is having some technical issues, but I am joined by my colleague, Gray Lepley, also of PFM Asset Management. And then we are co-managers for the city. And so we do have our partners from SWS Capital Management, which will also provide an update as well. I know time is of the essence, so we'll be really brief with regards to our presentation with regards to the city's finances. And so really quickly, just for everyone's edification, PFM Asset Management has been managing the city's funds actually for over a decade now, since April of 2013. And not only do we just manage funds, but we take a holistic view in terms of educating and training the city staff and just looking at the whole investment process in aggregate. So over the last decade, we have revised your investment policy, extended the duration of your core funds, assisted the city with regards to its bank custodial services, and then just opened up new accounts and further diversified the city as new funds have come in. So just gives you a brief recap of some of the things that we have done over the last decade for the city of St. Louis. With regards to the city's current assets, on this page, we show a summary of the assets under management only for the funds that PFM Asset Management manages on behalf of the city. This information is as of June 30th, 2023. Also, this does not include any assets that the city may have at local banks. This only includes those accounts and portfolios that are under the direction of PFM Asset Management. Later on, our co-advisor, SWS Capital Management, which is a minority manager, will go into detail about the bond and debt funds that they manage for the city. But here we do show assets that are broken out into two different groups. On the top, you can see the longer term portfolios that PFMAM manages for the city, including airport portfolio, airport PFC portfolio, and city general pool portfolio. All three or more reserve-like portfolios that are akin to a rainy day funds and are managed to a 0 to 3 year strategy and total over 162 million as of June 30th. And then below, we show the balances in MOSIP. MOSIP stands for the Missouri Securities Investment Program. That is a local government investment pool specific to Missouri public entities. And it's very similar to what you would think of as a money market fund. The city does have various different accounts in the MOSIP program, including a general fund account, as well as assets for other city departments, including water funds, park and division funds, fire debt funds, and things of that nature. And then even some of the ARPA funds that the city received from the federal government, as well as the RAM settlement proceeds, are also invested in the MOSIP program. And as you can see here, the amount of monies that the city has in MOSIP total over 549 million as of 6/30. And in total aggregate, you can see that the city had over 712 million in assets through its engagement just with PFM Asset Management. Here on the next page, we show a little bit more information that further summarizes the assets we manage on behalf of the city. One of the things I want to point out is that interest rates have risen significantly over the past 2 years, and my colleague Gray Lepley will touch on that even more just in a little bit. But that being said, on the top table, you can see that the average yield at cost, or the average yield of the securities in the 3 portfolios at the time we purchased them, was 2.27%. But then you can also see the yield at market, which is the yield of those same securities at a point in time as of June 30, 2023, which was 5.13%. And this just is really just illustrated of how much yields have gone up over the last year. As mentioned before, we do manage these portfolios to a 0 to 3 year benchmark, and you can see that the average duration or the average maturity of the portfolios was 1.26 years as of June 30th. And then on the bottom table, we show the performance for the 3 portfolios we manage compared to the benchmark for the quarter ended June 30th, and for the past year, 3 years, 5 years, and since inception. And as you can see, the portfolios have outperformed the benchmark for those different time periods that are listed. One thing I'll state is that we do take a long-term view when managing these portfolios, since they are long-term core reserve portfolios. And that's why you see consistent outperformance over the benchmark since inception of these portfolios in 2013. We may not necessarily outperform for every quarter, but our goal is to outperform over longer periods of time. And just know that the main objectives listed in the city's investment policy is safety, liquidity, and then yield. And we will continue to strive to meet those objectives in that order in the management of the city's funds. And speaking of yield, here we're taking a look at the earnings picture. It should be noted that 2 years ago we were really in a dire interest rate environment where yields basically had fallen very sharply to just 0% for the most part. Now, with the continuous moves by the Federal Reserve to raise interest rates, that has definitely impacted the city's funds, and you can see that in the yield at cost increasing, which is the yellow line on the graph here, and that has led to interest earnings being significantly higher than at any time we've managed the city's funds. Yields have gravitated higher, and short-term yields are at the highest levels that they've been in over 20 years, which really speaks volumes for the interest income that the city has received. So the combination of higher interest rates combined with the influx of assets that the city has received in terms of ARPA funds and the RAM settlement proceeds over the last couple of years has led to the significant increase in earnings that you see here, particularly for fiscal year 2023, in which net earnings totaled over 17 million in just FY 2023 alone. I note that we do have a lot more information in this report that shows additional data about your portfolios and earnings that we won't go over at this meeting, but you definitely can peruse that at your own leisure. And now that I've ended my part talking about interest rates, I'll turn it over to my colleague Gray Lepley, who will briefly go over the current and future interest rate environment and how that will affect your accounts and your portfolios and strategy going forward.
Thanks, Danny. Can everyone hear me okay? Okay, fantastic. All right, so we're going to start on the next page. And as Danny so eloquently spoke just a few minutes ago, to take a step back, rates have continued to move upwards significantly over the past year and a half, but even this year as well. So there was one rate hike in May, there was a hold in June by the Fed, another rate hike in July, and then most recently at their September meeting, the Fed decided to hold again. What we're showing here is the Fed dot plot from the September meeting. And really what this is showing is where interest rates, according to the Fed, are going to be going. So overnight rates currently are at 525 to 550. How long are we going to see rates at that level? Well, the Fed, according to this, is keeping another rate hike on the table for the remainder of this calendar year. The dots, if you look at 2024, also show that the Fed is likely to keep rates elevated for longer than originally anticipated. Before the September meeting, the expectation was for maybe 4 rate cuts to happen in 2024, starting in May or June. That has since been changed to maybe 2 rate cuts starting in August, September, sometime in that time frame. So this higher for longer mentality is really what is kind of taking hold at this time. We can move on to the next slide. Looking at some of the other projections from the Fed, as you can see in the top left-hand corner, we're showing the change in real GDP. The question on the table has been whether or not there's going to be a recession. And as of now, the Fed is not projecting that there will be a recession this year. They're expecting that we're going to see economic growth of 2.1% on average for the year. That's on the heels of 2 quarters at or above 2% in the first 2 quarters of the year. Current estimations for third quarter GDP are somewhere between 3 and 5%. Unemployment remains very strong as well, currently sitting at 3.8%. The Fed is expecting it will remain somewhere near there by the end of the year, but then soften to a certain extent into 2024. And to be frank, they want it to soften to a certain extent. So some of the demand comes down so that they're able to get inflation under control as they continue to raise rates. And then, of course, speaking of inflation, in the bottom left-hand corner, we're showing what the Fed is expecting for inflation moving forward. The Fed's target for inflation is an average of 2% over time, and you can see that they are not expecting that they will be able to achieve that until 2026, if not later. So at this point, even though inflation remains around 3.7% currently, if you look at CPI, that's still above that 2% target. So the Fed still has some work to do when it comes to what they're going to be doing with the overnight Fed funds rate. If we move on to the last slide, this gives us a picture as to what the Fed's path has been really since the start of their rate tightening campaign. So you can see there were 4 75 basis point rate hikes during 2022. And then most recently, we've seen 25 basis point hikes, including the one in July. The 2 diamonds are showing where the Fed is projecting overnight rates will be by the end of 2023 and 2024. Again, at this point, the Fed is expecting that there could be one more rate hike this year, maybe in November or December. With the information we've received out of Israel this past weekend, the market is expecting at this point that that's unlikely to happen. There had been maybe a 50% chance of that occurring. Now that we've seen the volatility from the markets as a result of the turmoil over there in Israel, the expectation is maybe 20 or 30% chance of another rate hike at this point in 2023. And into 2024, you can see there's a dichotomy between that diamond, which is what the Fed is projecting, and the blue line, which is what the market is expecting in terms of overnight rates. So the takeaway here really is that we're going to see overnight rates start to come down into 2024. By how much? That remains to be seen. Again, it's less than what we had expected a few months ago, probably 2 rate cuts at this point into 2024, but those overnight liquidity vehicles, most of things of that nature, are likely to start to come down. We don't have it shown here, but I did want to speak briefly to the overall yield curve because we are investing in that 0 to 3 year space, which is obviously not entirely shown on this page. Yields in the 1 to 3 area are at the highest that they've been since 2007, 2008. So we think that it really continues to make a lot of sense to be purchasing securities in that area of the curve, being able to lock in those yields, take advantage of the rates, the highest rates that we've seen in years, to really produce income in the portfolio. Income generation is extremely important, of course, and we expect that that's going to continue to provide dividends for the city. That's all I had. I'll turn it back over to Danny.
Sure. Any questions or concerns with anything that we've talked about before we turn it over to our partners at SWS Capital Management?
Hi, Danny. Mayor Jones here. Good to see you.
You too.
I wanted to ask more if Greg could do a deeper dive on the projections of a recession. Comptroller Green and I have been watching that pretty closely, along with our budget director, and also, obviously trying to make sure that our decisions around our city's finances are reflective of these projections. What do you think led to the Fed's reversal of a pending recession?
Yeah, that's a great question. So a few things. First of all, we've seen extremely strong economic growth over the past 2 quarters. If you look at Q1 and Q2, those numbers have been very strong, above 2%, which was actually quite a surprise. The expectation was for maybe 1% economic growth. And as you recall, back at the end of last year, we were expecting that there might be a recession by the end of this year. What we've seen this quarter, especially if you look at some of those projections, I told you they were between 3 and 5% for just this quarter alone, Q3 that just ended, I suppose. The reason we're continuing to see that be so strong is because the consumer continues to spend money. A lot of that has come from, of course, fiscal stimulus measures that we had through the CARES Act and other things like that, similar to the ARPA funds that you've received. But we are also seeing consumers continue to spend down their savings to a certain extent, which is something that we're keeping an eye on, of course, because there is, there are obviously ramifications that can come from that as well. So when you talk about what the timing of a potential recession is, of course, I can't give you an exact time frame, but what I can tell you is what the data is showing. And what the data is showing is if you look at, for instance, Bloomberg economist surveys, 50% of those economists that have been surveyed are expecting that within the next year, we will see, there's 50% chance essentially that we will see a recession. So we're definitely seeing a slowdown. We're expecting to see a slowdown. Some cracks are forming. And I think you can see that too from even despite the fact that we're seeing the unemployment rate remain very low by historic standards, you are starting to see some cracks showing in that space as well.
Okay, thank you.
Absolutely.
Any other questions?
For me, thank you. Thank you, Danny. Thank you, Gray.
Thank you, Danny.
If there are no questions, I will turn it over to our co-managers, SWS Capital Management, to give a brief update on the finances that they manage, and they could probably also speak to the mayor's question with regards to possible recession or no recession as well. So Daniel Potts, John Feaster, feel free to take it away.
Great. Thanks, Danny. Thank you, Treasurer Lane, Mayor Jones, and Controller Green for having us. I want to introduce myself. My name is John Feaster. I'm the Senior Portfolio Manager for SMA Management at SWS Capital Management. My fellow Portfolio Manager, Daniel Potts, is also on the line. And also my Head of Client Services on the line. However, he's having some technical difficulties. Keith Lathan, he called into the call and he's listening to it, but he won't be able to speak to it, but he sends his regards, and next time he'll be able to get in on the Zoom call as well. SWS Capital Management is the asset management affiliate of Siebert Williams Shank, one of the largest financial services firms in the company. That's MBE and WMBE majority owned. So we are the asset management affiliate of Siebert Williams Shank. We were recently hired through the RFP process to manage funds for the city of St. Louis, and we started doing it in March 1st of this year. So this quarter, which basically represents this presentation, represents when we onboarded accounts and when we started managing accounts. So we will have a somewhat different presentation for our next meeting on the Funds Committee next year, as well as our quarterly meetings, because we technically start showing performance to benchmarks after a full quarter of management. That being said, we want to talk a little bit about what we've done this quarter and how we've structured the portfolios from the previous manager to our current strategies. Dan, can you move on, please? So some of the highlights from the quarter, from an operational perspective, we onboarded, I believe, 28 accounts. And these accounts, which will go on the next couple of slides, are in different functional areas for the city of St. Louis, airport, parking, municipal finance corp, convention center. And so for this sort of presentation, we sort of pooled the investment performance of the portfolios to the individual sections of the city, or else this report would be hundreds of pages long. So this quarter, since we started the engagement March 1st, we onboarded all the accounts with multiple custodians. We established automated custodial feeds and processes, and we worked with the trustees to establish processes and documentation for all the accounts, as well as worked within the individual departments to understand their individual cash flows. So we are meeting, obviously, with Treasurer. We're representative of the Treasury area, but we're also meeting with the different areas of the government to understand their cash flow projects and projections to better serve them in the management of these accounts. We also were transitioning these accounts from the previous manager to our current strategies. And to do that efficiently, we kept a lot of the legacy positions from the previous manager, as they were primarily maturing in the first week of July for a handful of these portfolios. But a lot of these portfolios, we were able to transition fully to our strategies. And to do this, we determined that would be in the best interest of the city because it minimizes transaction fees from doing so many trades. Dan, you can move on, please. These are sort of the groups of the portfolios we manage. So we separate all of the AUM in this slide. Fixed income represents coupon treasuries, coupon agencies, certificates of deposits. Cash and equivalents are money market securities. So they represent commercial paper, treasury bills, anything that's shorter than 1 year and doesn't have a coupon. So that's sort of how we break down our assets from traditional fixed income coupon securities, and then cash money market securities, which again are commercial paper, treasury bills, discount agency notes. So in the individual portfolios, we manage about $97 million. Airport is our biggest grouping of accounts, which is about $69 million, followed closely by the Municipal Finance Committee improvement bonds for the convention center, and then followed obviously by Forest Park, Carnahan Courthouse. A lot of the mandates that we manage for the city are bond indenture accounts. What that means is we manage the portfolios for payment for the outstanding municipal debt. So a lot of these accounts have tremendous cash flow needs from coupon to coupon. We also manage a significant amount of accounts for example, parking that are based upon revenue bonds. What that means is that revenues collected from different facilities, and it's distributed through different periods of the year to make coupon payments for the outstanding bond issues for semi-annually. So a lot of these accounts that we manage, not all, but a lot of them have significant shorter duration mandates based upon the bond proceeds. Many other of these accounts have longer mandates, and we are, once we understood the different needs for the different pools of money for all these different areas, we then tailored our strategies to increase duration for the majority of these portfolios that were not bond indenture accounts. Dan, you can move on to the next slide. So this is a good example. We kind of grouped portfolios as of the different areas that we manage. So this is what the bulk of the airport accounts look like. As I said, these portfolios still have a lot of legacy positions, so they'll be somewhat changed over the next period of over the next quarter. However, you're going to see a breakdown composition of bills, agencies, certificates, deposits, and commercial paper for all these individual accounts. You'll have some of these accounts in these groups have longer durations, such as 1 year. Some of these accounts have longer durations, as I mentioned before, because of the bond indenture accounts. But we work with the different departments to pick a benchmark that is most reflective of the cash needs and the performance of that account. So we'll have some accounts that are benched against 3-month benchmarks, and then we'll have some accounts that are benched against 1 year benchmarks. But for this purposes of this meeting, we grouped all these accounts together. And then Dan, you can move on. It's going to show just another composition of all these airport accounts. As I said, we're in the process of lengthening duration because when we initially took over management of the accounts, duration was very short. Duration is just a measurement of sensitivity to interest rate changes. So they were looking representatively between 1 month and 2 months. We'll be taking a lot of these accounts out to 1 year. To basically, as Gray said, taking advantage to parts of the curve, the yield curve that offer higher returns historically than they've been in quite a long time, and to try to lock in those returns to maximize yields and returns going forward. Dan, if you can move on, you'll see a lot of report. For instance, this is an account, Carnahan Courthouse, where they had a position of security that matured in the 1st of July. So we decided to leave this maturity on, and then once matured, we were going to reinvest in our strategies of diversification and longer duration. Dan, you could probably skip a lot of them moving on because they're all very similar in nature. They just represent the different areas that we manage for the city and composition of the portfolio. Here's our earned income report for the different areas. We sort of grouped it together. Again, these are representative. So when we started the accounts, so even though we started managing accounts March 1st, we didn't actually start. The onboarding process took a number of weeks. So the earned income is representative from when each account started in that group. So you'll have some accounts that start at the end of March and some accounts that started in April. That's representative of the earned income report. You can move on, Dan. And finally, we like to give performance. As I said, this is reflective of when we started managing the accounts. However, it doesn't reflect the entire time period. Going forward, we'll have performance report that are matched against benchmarks, so we can sort of look at them for what these accounts should be benched against. We don't, as I said, we sort of track performance, but after the first quarter is when we really start to match performance to benchmarks, longer benchmarks or short benchmarks. Dan, you can move on to the next one, I believe. And we'll stop right there for any of our questions regarding the management or the accounts. As again, does anyone have any questions?
Thank you, Daniel. Thank you, John. My question more so about the bond market and the future facing outlook, thinking about our issuances that we have as a city. And I know the answer might be a very long time, but where do you all project the next possible refinance window being?
Well, Treasurer Lane, so the Federal Reserve, as Gray mentioned before, has embarked on this cycle, and they're reaching the end of obviously the rising interest rate cycle, but they've started the messaging of higher longer. And as Gray mentioned, the reason why they saying higher longer is because the data which they base all of their projections for the monetary policy has been very resilient. As Gray mentioned, GDP has been revised up, which was very, to a much stronger number than was originally expected 3 months ago. The jobs market has been very resilient, even though we're in this tightening monetary policy and restrictive overall economic path that the Federal Reserve has taken us down. The job market has remained very resilient. And then lastly, their third thing they looked up as prices, meaning CPI. And even though the trajectory of inflation has been trending down, disinflationary, going down, getting to the target rate of 2%, the Federal Reserve feels might be sticky, meaning it might take some time, and that's why they're sort of messaging that higher for longer. So as far as rates remaining higher for the, I believe, as Gray mentioned in the dot spot chart, they pushed out their interest rates being cut till, to outward 2024. And even at that point, rates well above 5% for the end of 2024. I believe it was 5.25% based on the current dot plot. Again, those dot plots are based upon what the FOMC is thinking that moment. However, I do agree in the sense that rates will have to remain higher longer in order to get their target prices to their target area of 2%. So that being said, the ideal window for refinance is probably a couple of years out, in our opinion.
Thank you so much, John.
I have a question.
Go ahead.
John, you mentioned that you were looking into longer duration for this particular portfolio of investments, which we know are bond proceeds and bond proceeds. Have you had a chance to speak with all of the departments to make sure that as you consider longer duration that there won't be a sort of risk to pull money out prematurely for any payments that arise, payment needs that arise?
I have with most departments. I have a few scheduled up. The remaining departments I haven't. However, all of our strategies are liquid enough where if there's unforeseen cash flows that we're not aware of, the money is available to be raised. So that being said, I try to meet with the departments at least on a yearly basis to understand their different cash needs. And the outstanding, I still have to meet with Airport to understand some of their cash flows for some of these longer term accounts. But other than that, I've spoken to obviously Treasurer and to Parking, but Airport is on my schedule. And we just have been going back and forth the last month, and we're going to get something on the calendar next month.
Okay, thank you.
You're welcome.
John. Christina, I see your hand.
Yes, and Mayor Jones, one of the things that we worked with Airport and working with the Comptroller's office is we're looking to put a schedule together to really move some of the liquid cash for reserves over into a longer duration for PFM, so that we know that rates are going to come down, and that the assets that I hold locally with banks as well as the MOSA portfolio has a lot of liquid cash, and we might need to move some of that over to PFM to be able to capture some of those longer rates, because right now we're just playing the short game, and that's not going to last forever. So with Bev and myself working on that calculation, we should know more shortly. And then Airport hasn't met SWS, but we've been working on some short duration 2-year cash planning forecasting and securing cash and setting aside. So a lot's moving in the background, but now that we have PFM and SWS working together and trying to figure out how we move for the next 2 quarters before rates start coming down. I hope that helps.
I do understand that. However, some of our local, more regional banks do depend on deposits in order to keep them afloat. So I would caution moving most of our liquid cash to some of the larger banks in order to make sure that we are supporting our local financial institutions as well.
Yes, you don't have the cash summary here, but as Danny said, this is only the investments. We do have over 400 million with our local bank partners. They're on today's call.
Thank you.
And Mayor, we make sure we stay in communication with them so that they can communicate their cash needs to us, and that's conversations that we have ongoingly with them.
Okay.
Any other questions, Comptroller Green?
I
Go on.
will make a comment. I have been involved in the airport program that's going to be pretty large. And the discussion there has been to take a look at a cash optimization strategy. And so that conversation is going to be rolling out shortly as to what that means with the amount of dollars that are going to be needed in terms of bonding those dollars, as we also have the liquidity in place. So it may be some strategies that we could use that would possibly reduce the cash in favor of reducing the cash versus bonding, depending on the timing, but that's going to be left up to the professionals.
All right, thank you, Comptroller Green. All right, any other questions before we continue? All right, go ahead, John.
That's going to conclude our presentation of the portfolios. Danny's going to bring up our combined broker-dealer list to be voted on the committee. I think we can do that right now.
So I'll just speak really quickly. This is the updated list of broker dealers to be approved by the Funds Committee. As you can see here, I would just note that the ones highlighted in blue are the new ones added from last year's list. And then we also do, as you can see, note the minority or woman-owned business enterprise of broker dealers that are on this list here as well.
Thank you, Danny. Any questions on the list from the group as you review? Okay. Seeing none, I'll entertain a motion to approve this year's broker-dealer list.
So moved.
Second.
Okay. It's been moved and properly seconded. Ms. Ali, can you take the roll, please?
Mayor Jones,
Aye.
Comptroller Green,
Aye.
Chairman Lane.
Aye. Thank you, Danny, Daniel, Gray, and John. So we will move on to the HMDA report. So I will share my screen and I'll be as quick as possible for the sake of time. These are the institutions that have contributed their data to and provided their data to us in our planning department to be able to get the data on lending in the city of St. Louis and really the region as a whole, and the banks that are up for approval by the end of this report. There's only one new addition, and that new addition is Paramount Bank. So last year we had 15. There are 16 this year. In terms of the report, so the full report is 71 pages. I will not be reviewing all 71 pages, but we have the report posted on the STL Treasurer website for those who want to review, but I will be highlighting a few things that I feel are important to note as we go year to year with this data. But loan volume by the loan types that we have, looking at some of the loan volume maps for our city of St. Louis and where those loans tend to fall. I'm also looking at those low to moderate income census tracts and being able to disaggregate the data by that, and looking at how we have the approval rate. So looking at the amount of loan originations to the applications. So on this slide, just want to say we start with the loan volume. So the rankings on the side there, 1, 2, and 3, that's by total loan volume. So not by home purchases, just so that is clear. But 912 loans that were issued among the 15 banks. I know I said we had 16 this year, but because of the low loan volume of rural banks of Missouri, they qualified to not have to provide their loan data. So that's why we're looking at the 15 banks there. This represented about 239 million, which was about a 27% decrease in total loan volume. And once I get to the next slide, you'll see clearly why, and also about a 10% decrease in the dollar amount. When it came to home purchases, though, this was actually an increase in volume and loan amount with 462 loans. I believe last year was maybe about 412, around that. And maybe just over 100 million. So we're looking at 157 million. So there was an increase here, but like I said, a decrease in overall loan volume. And it wasn't because of home improvements, which also went up, but as we've discussed with the market outlook, because of refinancing. So we saw a 56% decrease in the volume and a 50% decrease in the amount of loans that were refinanced, which makes a lot of sense. Rates are going up. It's more expensive to borrow. Therefore, you are not doing a lot of refinancing. But even with that, there were 289 loans issued in the city of St. Louis for that purpose. In terms of the loan originations to loan applications, so the rate at which loans are getting approved, these were our top 5. So Midwest, again, actually was #1 last year, but with a higher rate this year. So I think they were at about, if my memory serves me correctly, 78, 79%. So that went up to 85%. I will also note that, with the volume, some of the banks that had the highest volume were definitely not on this list, but when you have more loans that you get applications for and send out, that tends to happen. But I do want to recognize these 5 for their origination to application percentage. And then looking here, it's a lot of numbers on this sheet, but looking at small business loan activity, I do believe that small businesses are the heart of our city. We love our chains, we love our big businesses, but small businesses are what make our city thrive and grow. I will highlight some numbers so you don't have to strain your eyes too much, but I do want to highlight the high volume for JP Morgan and US Bank. And US Bank is one of our city depositories that does a high volume of work in the city of St. Louis. So we're happy about that. Just like last year, I do want to draw your attention to, of these loans, the number of loans that are less than $100,000. Sometimes there are loans that go for just those big amounts. And again, great to have loans for those large amounts, but we know sometimes small businesses will thrive off of a loan that is less than $100,000 to be able to continue their business. So we're happy that all of our bank partners are involved in that way to make sure that those loans aren't forgotten and that we are distributing them. Going to the map, and I know I have I've been looking at this year after year and also recently, so I know what the maps look like last year, but we always like to see, what does it look like for our city, knowing that we want to uplift and support the most marginalized areas of our city. So with loans overall being down, again, particularly for the refinance part, but home loans going up, just wanted to see what the trends are. So if we look at this, we're getting greener and fuller, which is great. And also last year, this top north portion on the right, so the northeast portion was a little bit more green. So there were some loans that were given out last year that probably carried over. But overall, we're seeing a fuller picture for the city of St. Louis, both in the amount and the valuations. Continuing to home improvement, we didn't see as many north. This is a continuing trend. But there were some gaps that were closed that were not there last year. So in the northwest corridor, there were more census tracts that were white than there are now. So I'm happy to see that our banks are continuing to close some of those gaps. When it comes to refinancing, again, this is to be expected with rates going up, not too much in terms of the volume. But again, an overall a pretty good spread. And I would say in the northeast corner, again, these two weren't represented and they are now in green. So I'm happy about that. And then last, this is a pretty good picture, but when we factor in all of the loans, so this would include our small business loans, we're seeing a fuller green picture. So again, something to be proud of and something that we can hang our hat on. I know it's something that I've spoken with a lot of our banks about, and making sure that we are supporting and sustaining St. Louis. So I'm glad to see that we're trending in a positive direction. I know I've said a lot, so I'm going to pause here before I go to the second half for any questions from the comptroller or our mayor. Hearing that, I'll continue. Okay. I always want to look at low income loan volume. So it's, again, looking at how our most marginalized communities faring. So last year I looked at low and moderate income and focusing specifically on low income this year. So of the originations, 75 loans, and that was 8% of the total origination. So as to be expected, but we want to focus on that number to see how that's trending, especially in a rising rate environment. And then the origination rate is something that I calculated as well. The overall for just all the total loan volume is 67%. By origination rate, I mean, we're looking at the total loans applied for and then how many actually were, how many loans actually originated. So essentially the approval rate of those loans. So overall as a total, 67%. For low-income areas, 52%. So of course, trailing behind, but not by much compared to a lot of other areas across the country. So again, a gap that we want to continue to see close, but it's trending in a positive direction. So very happy to see that for the city of St. Louis. This is our benchmark. So these numbers are the same as last year, and this is pulled from the 2020 census. And I talk about why we focus on looking at those numbers for the low to moderate income populations. But this is what we're up against. So if I look at low to moderate income census tracts, you can see the data as it pertains to how many of those residential units are owned or owner occupied. So we know that the ability to increase home ownership in the city of St. Louis and increase home ownership for those who have been historically disenfranchised is huge. We want to make sure that that happens. It leads to a thriving city. So these are gaps that we want to close. We want more home ownership all across the city, but especially in those LMI census tracts. I'll continue on, and for the sake of time, we are not going to show all the scorecards, but I will say that last year we introduced the Banking for Economic Equity, or BEE scorecard. It is a tool, a comprehensive tool that we are looking at to evaluate our banks on their effectiveness in a bunch of areas, and I'm going to skip to those areas just for the sake of time. But the top two, we're looking at diversity of the workforce, especially at the top. So we're looking at the leadership diversity. So what do your boards look like? What does your executive leadership team look like? Your partners, and then C-suite. So those who are client facing, those who are in managerial roles, what does it look like in terms of the gender diversity, the racial diversity, and all other forms of diversity that matter to us. Equitable lending is essentially the HMDA report that we just looked at. So where are you lending? What does your volume look like in those percentages that I already talked about? And then the last two is, what does the investment in the community look like? The last one, community-focused empowerment. So in what ways are our bank partners investing in St. Louis, in our nonprofit institutions, in our education institutions, to make sure that we have a robust and thriving city. And then with customized products and programs, knowing that there have been historical barriers, and historically, our banks have been some of our biggest perpetrators of this. Knowing that that history is true, what is your bank doing to go above and beyond to be able to create access in equitable ways? So we will be posting the scorecard on our website. I want to give a special thanks to all the community partners who have given feedback on the rubric in the last year to allow us to hone it and make it better. And I definitely want to thank my treasury team. So my assistant treasurer, Christina Bennett. I want to thank Devin and Angela and Dusty for spending time with me going through all the data that the banks provided to be able to compile those scorecards. And again, the HMDA report, the 71-page full report is on our website, and that will be available. Each scorecard for every bank will also be available. My ask to the banks and our bank partners that are here today is that you designate one person or a small team to be able to review your scorecard with us. So I will make sure that we send out both your scorecard personally to you, in your bank and the bank representatives that you have. And we would like to have a conversation about it. Again, this is not a punitive measure, but this is a reinvestment in the commitment that we have to St. Louis, and talking about how we can be as best as we can for the city of St. Louis and those who call the city home. Skip these for now. Simple. I want to recognize all of the banks. So we've seen the list, but I want to take a moment to recognize these banks, because I have been making the charge, and I know Mayor Jones, when she was treasurer, has been making the charge. I know our comptroller as well, is to make sure that our banks and bank partners are investing in St. Louis, and that can't be overstated. And it's not just writing a check, but it's being involved, being present, and being visible. So all of these banks, and I can get very sentimental, but from Regions and having the big bike that goes into many of our parades that down Market Street, and making sure that folks have access to quality banking. All of our banks do a great job of this. Midwest Bank Center is always in the community, as well as all of the banks are showing up and showing out for organizations. And then the partners that we have shown up to our events as well, to make sure that our city employees have access to quality banking products, as well as everyone in the city of St. Louis. So can't shout you all out enough. Recently went to an event at the Urban League with Simmons Bank, who now has a bank branch, one of the only bank branches, I think the only bank branch in that footprint in that area, over on Kings Highway and MLK at the Urban League building, and had just opened that up. So these are the things that we are saying matter to us at the city of St. Louis. And we know these are things that are going to continue making St. Louis the place that it needs to be. I'll also, and I could go on ad nauseum, but Commerce Bank and the work that you all do to make sure that you're investing in young people all across the city of St. Louis as well. And again, I could go on and on. I want to give a special shout out to these banks. Wells Fargo is not a partner, but recommitted. So recommitted a $250,000 investment into our College Kids program. So I want to thank the partners, even the ones on the previous pages that have been involved. And if you don't see your logo here, please charge it to my head, not my heart. But we want to just say a special thank you for the investments that you've made into, again, directly into the futures of young people in the city of St. Louis. So since we're at 3 o'clock, I will open it up to any questions from the comptroller or the mayor, and then we will close shortly after approving our depositories.
I might also add, if a bank doesn't see their logo there for supporting College Kids, and it's not because of Treasurer Lane's forgetfulness, reach out to Treasurer Lane. We're always looking for more supporters of our babies. Thank you very much. Shameless plug.
Thank you. Okay. All right, so with that, I've made all my charges. With that, I'll entertain a motion to approve our city depositories for this year.
So moved.
So moved. Second.
All right, it's been moved by Mayor Jones, seconded by the comptroller. Ms. Ali, can you please take the roll?
Mayor Jones,
Aye.
Comptroller Green,
Aye.
Chairman Lane.
Aye. Okay. Motion passes. Next is new business. I don't have any, but I will open it up to the mayor or the comptroller.
None here.
I don't have new business, but again, a comment, and I haven't really looked at the scorecards very closely yet, but I'm hoping that we can see within that information the investments that our banks are making in affordable housing as a separate category.
Affordable housing. Thank you, Comptroller Green. And with that, I did thank my treasury team. I also want to thank our investment managers, bond managers who were on the call. And I especially want to thank our bank partners. When I introduced the scorecard last year after this meeting, I got a lot of calls and a lot of emails from our bank partners saying, we can't wait to submit our data. This is something that we're looking forward to. This is work that we are committed to and have been committed to for a while, and we'd love to show off the great work that we've been doing. In addition to the information that all our banks send out for the HMDA report, we asked them for more. So we asked them about their who's on your board. We asked them to give us the breakdowns of the racial and gender demographics. And they were willing and able to provide that. And we had follow-up questions for them as well. So in addition to just putting out the scorecards, we will have that qualitative information in addition to the grade. And then we'll also be publishing everything that we can in terms of what was submitted by the banks to allow you all and members of the community to be able to see what our banks are doing. All right. Well, thank you all. Thank you all for being here. We have nothing else, so I will entertain a motion to adjourn.
So moved.
Second.
All right, it's been moved and properly seconded. Ms. Ali.
Mayor Jones,
Aye.
Comptroller Green,
Aye.
Chairman Lane.
Aye. All right, take care. Have a great day, St. Louis.
Thank you.